Hello, in this presentation we will compare QuickBooks Online versus QuickBooks Desktop. Hello, in this presentation we will discuss the adjusting entry related to prepaid insurance within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses, and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be doing the adjusting process related to insurance here. To discuss that adjusting process, let's go to the reports. We're going to go to reports down here on the left side. We're going to start off with the report of the balance sheet, the financial statement report of the balance sheet, clicking on that item. We're going to be running this report for the 2-month time period of 01/01/21, January 1st, 2021 to 02/28/21. That's going to be the time frame we are working through, January 1st, 2021 to February 28th, 2021, and run that report. Here's the report that we have now. And what we're doing on these adjusting journal entries, so these are going to be the types of journal entries that we're going to make as of the cutoff date, as of the date we make the financial statements, in this case, the end of the month of February 28th. Our goal then is to make the financial statements as correct as possible on an accrual basis as of the cutoff date of February 28th. The prepaid insurance is one of the standard types of adjusting entries we'll have in practice and in textbooks. Remember, when we look at these adjusting entries, we typically have one balance sheet account, this is the balance sheet, and one profit and loss or income statement account. And we typically will not be dealing with cash, which is a bit unusual because when dealing with non-adjusting entries, normal entries in other words, we often deal with cash. So here we're probably not going to be dealing with cash, and we're going to have one balance sheet account, one income statement account. If we look at the balance sheet accounts we're dealing with prepaid insurance. And the income statement account then, as you may have guessed, will be insurance expense. So what we typically do when we set up the system, if we're planning through the system, is we'll tell the accounting department, or if we're the accounting department, we're going to say, we're going to post any insurance payments to not insurance expense, meaning we're going to credit cash, and debit, or the other account, will be not insurance expense, but prepaid insurance, an asset account, not a profit and loss, not an income statement, not a deduction of net income account. And the reason for that is that prepaid insurance will be something that we pay for before we get the consumption of the insurance, before we use the insurance policy. And typically a lot of businesses will pay significantly in advance, meaning 6 months in advance to a year in advance. And therefore, if we write off that whole payment in the time that the payment is made, it could significantly impact the financial statement correctness, because really we should be allocating the expense on a monthly basis as we're consuming the insurance, rather than when we paid for it. Now, if we had recorded this as an expense, then we'd have to do like the reverse of the adjusting entry we will do here, meaning we would make some of it prepaid, as opposed to having the whole $11,000 written off whenever we wrote the payment off in. So here we're typically, if we can plan it first then, and plan for the adjusting process, we're going to say, hey, put it into prepaid insurance, and at the end of the month or the end of the year, we'll just fix it to make it whatever it should be by doing this adjusting entry. So what we're going to say here is that if we click on this prepaid insurance and see the check was written, here it's a check that was written for $11,000. If we select that check, then we can see the check, and here's the actual check. Now we're going to assume that this check was written for an entire year's worth of insurance. So we'd have to look at the policy, of course, to determine that. We're going to say this is a year's worth of insurance. I'm going to close this back out. We're going to go back to the report. And so what we're going to say now is that there has been 1 month has passed since we purchased this insurance, meaning we consumed 1 month. So it's a fairly simplistic calculation. We're going to say that we're just going to say that there's $11,000 that we paid for 12 months. Now 1 month has passed, and therefore no longer 1 month's worth of that is an asset, and 1 month has been expended. So we'll take that and divide it by 12, and that's going to give us the 916.66. this will be, and we're just going to round it to 917. So this is going to be the journal entry we will do. What we're going to do is we're going to say that this needs to go down by 1 month, which is 917, and that the related expense account needs to go up by the 917 for the month of February, and therefore bring net income down by 917. That is the transaction we will do now. Typically we would do this by selecting the plus arrow down here, so it's a plus icon, not really an arrow. We're going to select the plus that changes to an X, and typically we would do a journal entry here because it's an adjusting journal entry, and typically all journal entries are done with the journal entry. But there's only 2 accounts affected here, so we're actually going to try to use a different process so that we do not need the debits and credits. We're going to use the registers if there's only 2 accounts, just because we can. And then when we go back in here, we'll see that QuickBooks still created a journal entry, but we can do this with registers. So if we were to do the journal entry, as we'll see when we get back into the journal entry, we'll debit the expense by 917 and credit the prepaid insurance by 917, bringing the prepaid down, bringing the expense up, and reducing net income by the expense amount. But we're going to do that with the registers, so we're going to close this back out and attempt not to know the debits and credits as much, or is to use the registers. And if you are good with debits and credits, then the attempt is to better understand the system here so that we can see multiple ways to enter this information. So then we're going to go to the accounting on the left side. And we are in the chart of accounts here, the first tab on top. Typically when we look at the register, we think of the check register. But any account that's a balance sheet account will typically have a register. We're dealing with 2 accounts here, insurance expense, which is an income statement account, and therefore not a balance sheet account, may not have a register. And then the other account we're going to be dealing with will be the prepaid insurance. So we're going to look for the prepaid insurance, which is going to be an asset. It's in order. Assets, liability, equity, income, and expense. Assets then being checking, accounts receivable, and then inventory, prepaid expenses. Here we go. That's what we want. We want the prepaid expenses, other current assets. This is the one. That's the one. So it's got 11,000 in it, as we saw on the balance sheet. We're going to select the register and work with this item. So there's the 11,000. We're going to create a new item here. It's not going to be a deposit, not a sales receipt, not a received payment, no refund, no transfer, no. We have to use journal. So it's going to be a journal entry, even though it's not going to look like the journal entry we just looked at. So it's going to be a journal entry, however. So all adjusting journal entries will be as of the end of the month, as of the cutoff date, which in this case is 02/28/21, February 28th, 2021. The payee, I'm not going to put a payee. The memo, it's going to be an adjusting entry. And I got a few capitals there that are probably unnecessary, or most definitely are unnecessary. And then we're going to say that we are going to decrease it because it's 11,000 increase, and we're going to make it go down by that month's worth that has been consumed, and therefore should not be included anymore in there in the prepaid amount. So there's that. The other side is going to be insurance expense. We could select the drop down and find it, and or type in insurance, and then it's going to be the expense over here in the type of account. So it's an insurance and expense in the type. So we're going to say okay, and we'll save that item. And there we have it. So it should be saved. Here it is. So now we're going to go back to our reports and see if it does what we believe it should do, which is to bring down prepaid insurance by the 917, representing 11 months still there, and then go up on the expense side for insurance, bringing down net income. Reports, left side. We're going to go to the balance sheet report under the reports, and we're going to change those date ranges once again to 01/21 to 02/28/21. That's February 1st, 2021. I'm sorry, that's January 1st, 2021 to February 28th, 2021, and run that report. So here is the report. We're going to scroll down to the assets section for the inventory assets. Prepaid insurance assets. There it is. We have 10,883 in it. And that should be 11 months now. So we're saying that if we took the original 11,000 divided by 12, because that's for a full year and we want to see how much it is per month, that would be 916. We used 917. We rounded to 917. And there's 11 months left that have not yet passed and therefore are prepaid and in that sense an asset, something we're going to consume in the future. If we take that 917 and multiply it times the 11 months that are still remaining, we get 10,087, which is close to the 10,083. It's off by the rounding because we rounded up by to the 917 rather than having the pennies there. So let's take a look at it. If we drill down on the prepaid insurance, then we'll see that 11,000 here. And then we see our adjustment for 917 leaving us with the prepaid amount of the 10,083. If we select this 917, which is, note, a journal entry, even though we entered it into the register, it's an adjusting entry here. And we select that item, we see not the register, but an adjusting journal entry in a journal entry form. We see the debits and credits. So this is the form, this is the default form that QuickBooks has to go to because there's no other document that it's going to be used. There's no bill, there's no invoice. It has to use a journal. QuickBooks wants some type of form, some type of journal as the last scenario if there's no other form. Also note that the way we entered it into the register, because we used the prepaid account, it said that we decreased that first. We did that first because we used that register. That's the way QuickBooks sees it. And therefore, QuickBooks put the credit on top, which again, if you're an accountant student, then you're probably, that may look funny to you because you always think that the debit should be on the other side. And note that that's just a convention, really. And usually the software does that. It makes you kind of put the debits on top, usually when we make journal entries or look at the GL. But it's not something that always happens, and it kind of depends on the software as to what's going on and when the debits will go on top. This one, because we used the register in the format that we did, they put the credit on top. And note, it's just a convention, and it doesn't matter which one goes on top, the debit or the credit, as long as they're in the debit and credit columns. So we're going to close that back out, and we'll take a look at the other side, which will be on the income statement or profit and loss. So we're going to go to the reports on the left side, and we're going to select the profit and loss report. We're looking for the profit and loss report, and then we're going to run that for the 2-month time period once again, which is going to be 01/01/212/02/28/21. That's January 1st, 2021 to February 28th, 2021, and run that report. So here we have the report here. We're going down to the expenses area where we have the insurance expense. Here's the insurance expense. It's got $917 in it, which was 1 month's worth of expense. That, of course, increasing the total expenses and therefore decreasing the net income. This is important to note on these adjusting entries. Note that oftentimes, as you'll see if you're in public accounting, you'll end up making the net income a lot lower than it was originally when you got the work because of these adjusting journal entries, and so it can be significant here when we go through this process, because it typically does end up reducing the net income, oftentimes making the books look worse than they originally were when they brought it. But they have to be done because, of course, this is part of the process. So that 917 was consumed and therefore is an expense in bringing down net income. If we select that insurance item, then we can go down here and we can see that 917. If we select that item, once again, we will then see our journal entry that was generated when we enter this information into the register for prepaid insurance. Hello, in this presentation we will enter adjusting entries related to prepaid insurance within QuickBooks Pro 2018. If you've been following along with us, we will be continuing with the Get Great Guitars problem. If not, that's okay. We will be doing adjusting entries related to insurance, discussing what they are, how to do them, and why to do them. If you have the backup to this point, you can restore that at the File tab and Restore. If we currently have the Open Windows list open, in order to open the Open Windows list, go to View, Open Windows List. The only open window is the Home page at this time. That is at Company and Home page. What we're going to do now are adjusting entries, those entries at the end of the time period, in order to make the financial statements correct at that point. They are part of the normal process. They're not problems or errors that have been made by the accounting department. And in specific with relation to insurance, we often set up the insurance in such a way that we say, when we write the check for the insurance, we're just going to say, write a check, credit the check, and debit prepaid insurance, because by insurance's nature, we typically buy it for at least a month, but oftentimes more than a month in advance to us using the insurance. And therefore, if we just expense it at the point in time that we buy it, then it's going to distort our income statement pretty badly, because we're going to have this huge expense at the point in time that we bought the insurance, even though it's really covering the other months. So when we compare month to month, we end up with a problem. So let's take a look at that, and let's take a look at how we can adjust that. So we're going to go to the reports up top. We're going to go to company and financial, scroll down first to the balance sheet, and we're going to select then the date range, going to the customize reports, and we're going to select 01/01/212 02/28/21, January 1st, 2021 to February 28th, 2021. There is our balance sheet. We will be concentrating this time on this $11,000 there in prepaid insurance. Double clicking on that, we see that we have the $11,000 here happened at the end of January that we paid for this. If we double click on that, we see that we actually wrote a check for this amount. The thing to note here is that we put this to prepaid insurance rather than insurance expense, which might be what we would think that we would want to put it to is insurance expense. However, if we did put it to an insurance expense, by the way, that's not a problem. We can do basically the reversing of this adjusting entry in order to adjust for that. But let's see why that might be a problem, and under an accruals basis system, why it's not really proper to do that. So we're going to close this out. Also note that as we do this, I'm going to close this out. The fact that we have an accrual thing checked off here and not cash does mean that QuickBooks is trying its best to record on an accrual basis rather than a cash basis. However, does not necessarily mean that we're all on an accrual basis. We do still need to make these adjustments in order to be really on an accrual basis in terms of reports that we want to process. And so let's look at some of these differences and why that might be the case. So if we go to reports up top, we go to company and financial, and we go to profit and loss standard, we can change the date range from 02/28/21. So January 1st, 2021 to February 28th, 2021. Now you can imagine what would happen if we put that $11,000 as an expense here. It's currently on the books as an asset. If we put it as an expense specifically in the month of January for $11,000, we would then show not income but a loss for that time period because of that $11,000. Now, in one sense, it's true that we spent $11,000, but if we were to compare, say, January and have that $11,000 expense to February, in which we didn't pay the $11,000, but for which the insurance is covering us for, it doesn't seem quite proper. We would like to use the matching principle to apply that out. We'd like to say, hey, February, we did just as good, all else equal, as we did in January, and we should be applying the same amount of insurance given the fact that the insurance is covering both January and February. We shouldn't be measuring February's performance, in other words, based on the fact that they did better because we didn't buy the insurance in February and we bought it in January. We shouldn't be docking January's performance simply because that's when the insurance happened to be purchased, but the insurance was purchased for 6 months. So what we need to do is allocate that in order to cover the time period that's being covered by the insurance. One system to do that, one good system of doing that, is to set up the insurance when we purchase it, not as an expense as we have here, but a prepaid account. So if we go back to the balance sheet, that in essence is what we have done here. So we're just going to set up the system. Whenever you write a check for insurance, it's not going to go to insurance expense, it's going to go to prepaid insurance. And then at the end of the time period, at the end of the month or the year, our adjusting department, ourselves, or an outside CPA firm can go in and make the adjustments necessary to be on a proper accrual basis. What would that adjustment be then? We'd have to say, okay, well, here's what we paid for the insurance. In this case, we're going to assume that that covered 12 months. So we paid $11,000 for 12 months. We paid for it at the end of January. or the beginning of February, and that means that one of those 12 months have now passed. So what we're going to do is we're just going to take that 11,000 divided by 12 months and about $916.66. And we can round here. This doesn't need to be exact for these adjusting entries as long as we want it to be something that's materially worthwhile for us to do. So we're going to say it's going to be 900, let's just say 917 will be the amount rounding to the dollar that we will make the adjustment for. And the adjustment is going to be recording the expense related to that 1 month and decreasing the prepaid insurance, meaning the asset's going to go down. We no longer have this insurance that we're going to consume in the future without having to pay for more of it. And we're going to recognize the fact that we consumed the use of the insurance by being covered over the prior month. Typically, the way to do this would be to go to Company and make journal entries. And if we do debits and credits, we would debit insurance expense and credit prepaid insurance for that 917. But we're going to do this with registers so that we can not use the journal entries and try to use the journal entries as few as possible and just use a register to do basically the same thing. So we're going to go to the banking here and we're going to go to Use Register. And we're going to look for that prepaid insurance. So we'll select the drop down. We're going to go to Prepaid Insurance and OK. And we're going to make our adjusting entry as of the end of the month as of 02/28/21. And we're going to say that this account is going to go down. So it's going to be a decrease of 917. And then all we have to do is choose the other account, which in our case is going to be insurance expense. We could select the drop down and find it, or we can just type in insurance expense. There it is. There's the expense account tab. And what QuickBooks basically is saying, okay, we want to decrease this account that we are in, the prepaid insurance, and then we're going to do the opposite to the insurance expense, which QuickBooks can just know that that's the debit or the credit, and do the other to the other. And so that's what's happening here. So in essence, this is a journal entry. It's going to be decreasing the asset account, which is a credit, and it's going to be debiting the insurance expense account will be the other side. And if we just look at the increase and decrease and use some trial and error, we can see that it's going the right way. So we're going to say OK, and then go back to our balance sheet and see if it does what we want it to do. What do we want it to do? We want that 11,000 to go down to this number. So let's see that. We'll go to the balance sheet. Here is prepaid insurance. And in essence, that's what should be left there is 11 months worth of insurance, right? So we said it was 916 about for each month. If we multiply that times 11, the number of months we have left, we have about 10,083 left that we will be consuming over the next 11 months. So then we're going to go down to the profit and loss and see if it does what we expect it to do here. That is, the prepaid insurance is recorded. Here's the insurance expense. If we double click on that insurance expense, we'll see that there are a couple items in there that were posted to the wrong area in a prior presentation. So I'm going to go ahead, I'm going to correct that in a format that by adjusting them here. So I'll show you how to do that, and I'm also going to tell you that QuickBooks allows us to make these types of adjustments, adjust these entries. Some software will not. We would have to make a journal entry to do this. So let me show you what the error is, and then we'll go ahead and fix that. So if we double click on these, there was two of them. This account went to insurance expense, and it should be going to interest expense. So typing that into quickly, it should be interest expense. So I'm just going to change that account and then say save and close. And there's the item now. So if we do that to the two items that are in there, then what we have done is move the expense account. Those two items should have been an expense, but interest expense. And then the insurance expense here, if we double click on that item, will now solely be this 917, the 1 month worth of insurance expense. And that's going to be the other side of the item. It's going to be decreasing our net income. So note that these adjusting entries have put us into a loss down here